Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government and Americans for Limited Government Foundation. And today we're going to be talking about the Biden economy, the latest jobs numbers out of BLS. The Bureau of Labor Statistics shows 467,000 jobs in the establishment survey of employers in the month of January. This comes off on top of another 500,000 plus jobs in December. So we basically have 1 million jobs in the past 2 months. Question is the economy overheating? Today, I'm joined with Americans for Limited Government President Rick Manning, and he's going to share his thoughts on this topic right now. What's going on, Rick?
Well, it does appear as though we are having an overheating of the jobs economy, certainly. This jobs report is going to be, we're going to talk a little bit about some of the vagaries of this jobs report, because there are some things that are interesting about it, but they're interesting to me anyway, but we're going to really focus immediately on what's happening on the economy right now. And there are a number of factors that are weighing in. The number that they're looking at when they talk about 440,000 jobs created this month is the number of jobs that businesses report to the federal government. They say, we're hiring this many jobs. We have this many new job openings. And so that's the number that they're talking about, with 440 million or 1,000 jobs being created. That's a big number. I mean, let's be clear. That's a big number. And when you combine it with last month's number, you're really looking at a huge increase in jobs that the private sector is creating. But what's the real implication of that? That's what we've got to look at. What is the real implication of that in terms of where we are economically? Because there's a lot of competing forces right now, and the economy is really in a transition stage. Maybe you should talk a little bit about some of those competing forces, and then we can talk inside where those jobs are coming from.
Yeah, and I think the biggest force is the economy reopening from COVID. And you can see the dip here in early 2020. We lose 25 million jobs in the household survey. I think it was like 23 million in the establishment survey, which is what we're looking at here. But just to give everyone perspective, before the pandemic on the establishment survey, there were 152.5 million jobs in the establishment survey. By April of 2020, with the economy closed because of COVID, it had dropped to 130.5 million jobs, and that's catastrophic. So I guess that's a 22 million job drop there. But now we're already back to 149.6 million. So there's only about, say, 2.5-3 million jobs left to recover in the establishment survey. So I'd say that from a labor market perspective, that's a very good news. Unemployment still very low at 4%. And so a part of the story, one of the forces that's happening, obviously, is the pandemic is ending. Omicron death rates are way down compared to where we were in early April of 2020. I just crunched those numbers yesterday, Rick, over from IHME. And the latest projection says 1.4% was the fatality rate in March and April of 2020. And now it's down to 0.025%. It's a little bit more than double than the seasonal flu. So I think that's what's happening. People feel more safe. They're coming back to the workforce. More companies are willing to open, have less restrictions. And I think we're seeing that across the board. And you'll see it more pronounced in freedom states or red states. Florida calls itself a freedom state now. Where states that opened up more rapidly might have borne the fruits of the recovery sooner than those states that were still insisting on lockdowns and vaccine passports, et cetera.
Well, we've certainly seen that in state unemployment rates, where the lowest unemployment rates are top 10 states in terms of low unemployment rates are all states that are run by Republican governors. The bottom 10 states are all states run by Democrat governors. This commonality is that the low unemployment states opened up or never shut down, in the case of South Dakota, and some of the states like New York and California opened up for a short while, and now they're shutting down again. So you have a real difference in terms of approaches. And given what we know about the COVID virus now, those who are advocating shutdowns and just really that level of draconian pursuit are not following the science. In fact, they're doing great damage both to their economy, to their people.
Oh
And
yeah.
it's not warranted based on the Omicron virus. So, but that's what
Oh
we're
no,
seeing in
that's
California, New York, and elsewhere.
and that's kind of where we were and where we are now. And that it's that I think, and you can see it turn up in the jobs numbers. So you can see the confidence rebuilding. And I think in 2020, of the 25 million jobs lost, more than 16 million were already recovered by the end of 2020. And so I think that's a major factor. And now we're getting back the rest of those jobs. And I think we're starting, though, Rick, to get to the tail end of the business cycle. And the ADP numbers are very interesting for the past.
Okay, who's ADP, Robert?
That's ADP Payroll. They process payroll for establishments such as those in the establishment survey, but not all of them. So it's a smaller data set. And in the latest ADP number, there was a 300,000 job loss, according to ADP. And then we come to the Bureau of Labor Statistics today, and they say, no, there was a 465,000 gain. Then I go back to last month's ADP report, and they say there was an 800,000 increase in the month of December. So maybe ADP is a little bit further ahead of the curve, possibility. And this 300,000 job loss came after the surveys were taken mid January. And it could be that this was a latter end of January.
That's a great point, because what people don't realize is the January job numbers or the December job numbers that come out of the government are the result of a survey that's done. It's not, they don't count every job. They go out and they do just like a poll in a presidential election, except for it's much bigger. It hits 50,000 households. And they go out to 50,000 households on the household survey anyway. They go out to about 25,000 businesses. But it's a massive survey but it's all in the very middle of the month. So the week in the middle of the month, from about the 12th to the 19th, 11th to the 19th, in that area is when the survey is out, when they get the data. And so anything that happens after that isn't incorporated in the data. And so it's a snapshot of what's happening in the middle of the month. And so if the ADP data is a snapshot of what's happening at the end of the month, you could have two separate credible sources with two directly opposite information flows based upon when that information is compiled.
Well, we have a comment here from Deplorable Stoic. I praise you for your stoicism. Just a natural rebound of the market. Sooner or later, Americans will have to go back to work, especially with government handouts ending. In fact, the surplus unemployment benefits have already been canceled thanks to the Senate doing nothing on Build Back Better. And so much of the pandemic unemployment assistance programs are pretty much gone. So you're kind of back to a normal footing vis-a-vis economic policy and incentives to get back in the labor force. And you saw those people come rip-roaring back into the labor force.
Robert, I think there's really an important point, though. Since a lot of the Republican states stopped giving those extended benefits in the middle July, August of the summer. Yeah. Whereas the federal government program ran out in the middle of September.
Right. It was a few weeks different.
The Republican states got a running start in terms of GDP growth. They got a running start in terms of employment growth. And it's part of the reason why Republican states have a significantly better unemployment rate than the Democrat states. But but your point is that, yes, that process has ended. The other thing, though, that a lot of the Democrat states have done, whereas a lot of the Republican states haven't, is they extended their unemployment insurance. They extended the benefits to people who much more broadly than some of the Republican states did. And because you had extended benefits, there was less of an incentive to go back to work, even if it's just normal benefits, expanded to a wider group of people. So you've got a lot of those kind of things going on. Basically, though, as you said, we are now, the federal benefits are gone. Those extended benefits are gone. And there is, and that's why, and quite honestly, why in November, December, and January, we've seen a dramatic increase of employment, because those Democrat states are now coming back to work. And some of those are your biggest population states like Illinois, New York, and California.
Yeah, and I would argue it might be just in time for the so-called end of the business cycle. And I've been
Right.
monitoring this for the past week or so. Is that the 10-year, 2-year spread? What is this? This is the difference between 10-year Treasury interest rates and the 2-year Treasury interest rate. And it is seen as a proxy for business cycles. And you can kind of plot where the recessions occur is when you're at peak business activity, the 10-year, 2-year spread is going to be really wide. But when you're getting to the end of the business cycle, the spread begins to narrow. And the reason for that usually is either the 10-year is people are betting on the long term that you're going to see lower growth. And so they stay in their 10 years while the short-term interest rates are rising as they are now. That is certainly what is happening right now with the 2-year Treasury is rising rapidly. And it has been since the Fed's taper has ramped up, and you can just see it in the. You can just see it in the.
Let's explain what that means. Okay, bonds are really tricky because they kind of are opposite world. When people don't want to buy bonds, okay, the interest rate goes up. So it actually is when the interest rate goes up, it means people are saying you have to pay me more to buy your product in terms of the interest rate. So a lot of times you think about, and so when the taper, the Federal Reserve has been buying a certain amount of federal bonds, treasury bonds, and every single month for a long time now, for 10 years. And so when they say we're no longer going to buy as many bonds, that means there's less demand for those bonds. And as a result, unless the private sector comes in and says, no, I want those bonds, you're going to naturally see the inflation rate creep up, or the interest rate creep up on those bonds, simply because there's fewer buyers in the marketplace because the Federal Reserve isn't sucking them up.
Right. And here we got the Salt Lakers saying, let's go, Brandon. Thanks for joining us, the Salt Lakers. Pleasure that you can join us here. Indeed. Let's go, Brandon. But you can see in the chart where the Fed was buying and then where they stopped. And the Fed is the biggest mover in bond markets. Make no mistake, especially in the short-term interest rates. That's when the Fed's doing quantitative easing. They're buying a lot of short-term paper to keep interest rates, particularly lending rates to banks, very, very low. This is one of the methodologies they do for that. And then when the economic emergency is passed under Bernanke and now under Powell, they say, all right, let's do taper. We're going to slow down our purchases, and boom, interest rates are rising. But meanwhile, on the 10-year Treasury, interest rates have been actually kind of flat, or relatively flat. And then you can see there is an uptick in 10-year Treasury rates at the end of 2021 and the beginning of 2022, but it's not rising as fast as the 2-year. And that's the difference there. Is when the 2-year rises.
Why does the gap matter? Why does the gap between the two matter?
Because when it narrows, it predicts recessions, and so everyone's going to pay attention to it.
Okay, and so essentially, when it narrows, what you're seeing is that people are willing to bet on the longer term, but unwilling to bet on the shorter term. And exactly. So as more money moves into the longer term, that interest rate goes down or stays stable. But if that same money, if it's going to the long term and going out of the short term, people saying, I don't want to bet on short term because of interest rates or because of inflation or whatever it is. And so they're getting out of the shorter term bonds because they're losing money on them. And as a result, you see the short term bond going like we do now. You see it going up like this. You see the 10-year going like that. And as a result of that, you end up with when this crosses.
Right, the inversion.
That once it inverts, that's what's called an inversion. Once it crosses, that's when it's a well-known, it is an absolute inflation or recession indicator.
And it has been. It predicts. In fact, it's predicted almost every single recession in modern history. In the mid-1990s, there was a head fake where it briefly inverted, but then it wouldn't be for a few more years And then there was another inversion that actually did predict the 2001 recession. And there was a slight inversion in late 2019. I thought at the time it might be another head fake, but the economic,
There's absolutely no way to know. There's absolutely no way to know
because of
whether it
COVID,
was because of COVID, and the
right?
whole thing collapsed. It may or may not have had anything to do with the
Right.
normal economic cycle or not.
Well, I think that we were getting towards the end of the business cycle, and that could have made the COVID recession worse than perhaps it might have otherwise been if it had happened much earlier in the business cycle. So that's another factor I think to consider is when you're getting towards the end of that business cycle, and then suddenly you experience a great shock, such as happened in 2007 and 2008. That was like rocket fuel for a recession that then took 5.5 years to recover the jobs lost. Here we are, just a couple more million jobs away from getting all the jobs back that we had lost during the COVID recession. But it raises the question whether the COVID recession recover, or better yet, whether the recovery from the COVID recession constitutes a new business cycle in itself or a continuation of the prior business cycle. It could be that it doesn't matter, that technically speaking, there was such a sharp drop, and you can see it in the employment data. There was such a sharp drop and then such a sharp recovery. I'm not surprised that you would have a very rapid business cycle. It would have taken us 5 years after the financial crisis to get this amount of jobs back. We did it in 2 years. So it's a very compressed cycle. So I'm not surprised it would end sooner.
And that V-shaped recovery is a direct result of policies put in place with Donald Trump, which quite honestly, philosophically, there's some challenges with, but we ended up supporting them for very simply, and we spent a lot of money. But the way they spent the money was to try to make certain that the small businesses that were getting shuttered, that were being destroyed by the shutdown of the economy, were given enough capital that they were able to stay in business. And because of that decision, rather than just pumping money on the demand side into consumers, because of the decision to really focus resources on the small businesses that were most vulnerable, the Trump administration created an environment when the economies were reopening that wasn't just empty storefronts, and that would take 5 years for somebody to be able to get the capital, go back in. Those empty storefronts were filled, and that's why you have what you see on that chart is a classic V shape,
right.
Certainly jobs recovery, and
it's exactly what Keynes predicted. Much to the chagrin of many conservatives who would have said no.
I would, but except for this, and I'll dispute the Keynes argument in this regard. Certainly, if we had just done a demand-based recovery where we just gave money to people, okay, those businesses still would have been shuttered. Because those businesses wouldn't have had the capacity to exist. At which point you would have lots of money chasing no supply, and so you would have a disastrous situation in terms of the inflation rate.
You mean if they had just done the child tax credit and just done the checks, but not done the small business side of it? That was the innovation that Trump and Mnuchin put in there.
Right. And that was the balancing act that said giving people money but having them have nowhere to spend it is stupid. And so they kept small business alive, small businesses that would have thrived if not for government action to shut down. Okay, that's the key. When I looked at this 2 years ago, I said the federal government's breaking it. The state governments are breaking it. They have to fix it. This is a taxpayer decision that we're willing as a federal policy because of this public health emergency, we're willing to break the economy. Well, we have a responsibility then to make certain that people don't lose their livelihoods. And Americans for Limited Government was one of the few groups in March of 2020 where we were pressuring along with hundreds of small businesses who sent in videos that I was pushing into the White House. We're pushing the White House hard to stop the artificial recession that they were creating and really put the rocket fuel into the White House, the political rocket fuel into the White House from small businesses who are getting creamed to have the White House say, wait a second, the damage is way greater than the benefit here. We're backing off now. And that's why by the end of April, we had the White House backing off of the push for shutting down the economy, at which point we started to see things open up. So understand, the Trump administration's really hit the problem and then said, wait, now we're opening back up and we're going to allow this V-shaped recovery to occur because we're going to get out of the way now. We've done what we could do to prop things up, to solve the problem, to spread to flatten the curve, as you remember that old saying. And now we're no longer going to have our economy being destroyed based upon the public health officials' predictions. And that was the real innovation. Yes, if you give a lot of money to people on the demand side, they're going to spend it, and and that's just true. But if they don't have anywhere to spend it, you end up with inflation. The problem that we have now with inflation, I think that's where we want to go from here. The problem we have now with inflation is we have a lot of dollars chasing a smaller amount of goods and services because we have a supply chain problem, because you do have some empty storefronts, and by and large, and for whatever reason, when you're going in to buy an avocado in Southern California, the avocado is $8.95 per avocado. So so you're now having a circumstance where there's fewer goods on the shelves. You've got some empty shelves, and that's straight supply chain. And part of it's COVID, and part of it is stupidity on the part of Democrat politicians who engaged in a wholesale war against the trucking industry.
Well, I do agree with that inflation is the end result of all of the spending, and I'll just review for everyone what we did spend and when we spent it. During 2020, there was the $2.2 trillion CARES Act that included the checks, the child tax credits, the small business relief, the monies for the hospitals, monies for the vaccines, money for everything related to COVID. After that, in December, there was a $900 billion Phase 4 legislation that brought up the 2020 total to $3.1 trillion. And so that was an additional spending that occurred. And so in addition, and that included an extension on, I think, some of the small business relief, but actually I think that came a few months earlier. There was a small extension in the fall, and then and by the end of December, though, they were ending that as well. And so then what you have is the Biden administration comes in, $1.9 trillion stimulus passed on budget reconciliation, another $1.2 trillion infrastructure bill, which included $550 billion of new spending. So 550 plus 1.9, that's about 2.45 trillion under Biden. And so you did 3.1, 2.4. And what's happened? The M2 number on Federal Reserve has gone to the moon. It's increased by over 5 million. The national debt has increased by about that same, about 5 million, 6 million. I'm sorry, 5 trillion, $6 trillion.
It's now above 30 trillion.
The national debt's now 30 trillion. We printed $6 trillion and we borrowed $6 trillion. So basically all of the new debt was basically off of printed money. And unsurprisingly, now we're running really hot inflation, about 7%. On this chart you see here is actually inflation as it relates to the 10-year, 2-year. So when the blue line is the 10-year, 2-year, when it drops, the business cycle is ending. And when it drops, inflation actually tends to be rising. What does this indicate? Well, I did some calculations. Whenever inflation gets over about 5%, you're usually on average about 14 months away from the end of the business cycle. What does this mean? Inflation has an inverse relationship with the business cycle. If inflation runs too high, the business cycle is going to come to a swift end, as I think it is right now. And as you see evidenced in the collapse of the 10-year, 2-year treasuries, most recently at 0.61%. I mean, it's almost a little more than 0.5% away from dropping. To get you the idea how quickly could it invert, it could happen like in one day. The 2-year treasury rose today alone 1.12. And so if it went up 0.5, and the 10-year stayed 0 on that day, you could be close to the inversion. So it could happen next week. It could happen 6 months from now.
That's one of those things that you look at. You say it's a little bit. Some of it gets manipulated a little bit, so it's not necessarily always knowable exactly what's going to happen. But I will say this: there's a reason why inflation has this impact. Inflation simply means your dollar is worth less. So in the last year, your dollar's become 7% worth, 7% less than it was last February. Okay. What that means is very simple. You might have gotten an increase in your paycheck of 4%. So in reality, you lost 3% this year. You're making 3% less under that scenario than you were last year. So because of that, it has the effect of sucking those excess dollars out of the economy. And because by making the dollar worth less, the dollar will always find its own value. The dollar will, because the goods and services are worth a certain amount based on supply and demand. That's the price point. And the dollar chasing those goods and services will drive that price up or let it go down. And that determines what your dollar is actually worth. And when the dollar's worth less, it means it just means that because you printed more, your dollar's worth less because it really has a stable value. It's just the market determines a stable value. And that's the way it is. So
yeah, the value of the dollar, that's the thing that's always operating in the background. If the dollar's getting stronger, it means it's more in demand. What usually happens under those, as it is right now, usually what happens when that happens is growth will be lower, inflation will be lower. You're projecting job losses, actually, as you see in the ADP survey. So it actually, a strengthening dollar could be, that could be some stormy waters that we're headed into right now. So it could mean that lower inflation, maybe even some price decreases are on the horizon, especially if the economy is overheating. Because what will happen is people basically run out of money in the high inflation economy. Households run out of money. That you see a collapse in demand. And that's when the job losses will hit. That's when the layoffs will happen, when that contraction in demand. And you'll be able to see it in the CPI numbers, probably, my guess, in 6 months.
That CPI is Consumer Price Index. And this is conjecture on Robert's part. It's a theory.
It's a projection.
I will tell you that he's focused on the demand side entirely. I will tell you, I think the biggest challenge we have is that you can't, if there aren't, traditionally in America, we have full shelves. We have an abundance of goods that we can purchase. And in today's America, that isn't true. And as a result, and it's partially because business has something called, where they replace something immediately. They don't store a lot of stuff in warehouses. It's just in time delivery process for getting things on the shelves. And so when you buy something at a Walmart, say, and it gets scanned at the counter, that automatically puts an order for that item in to their system. And then, so that item's now ordered and it's being shipped. And so it's a process that's very efficient. But when things aren't able to be delivered through the ports of Long Beach and Los Angeles in a timely manner, you have a backlog. You have sort of a delay in that thing and what was expected delivery times. And so you've got that problem of empty shelves creates an artificial increased demand because you've got the dollar and a lot of dollars chasing fewer goods, which drives those goods up higher. And until we get the empty shelf problem solved, you're not going to see the inflation rate go down.
Well, I mean, it implies that you can't have a recession with high inflation. With high inflation, I guess. Here's deplorable.
We proved that you could do that in the 70s. Jimmy Carter.
Oh, but that's usually when inflation. That's my point, though. That's usually when inflation drops, and when the recession comes, that's when it will drop. So if it starts dropping, that's probably a very bearish signal. That's what I'm saying. If deplorable Stoic says inflation and crime destroyed the Carter administration, as it will Biden's, I think the odds on that are rising by the day, Stoic. After the Carter disaster, Reagan brought a decade of conservative prosperity and domination. Hold the line. I actually just wrote a piece about this, and that is the piece that you're looking at right here. You can find it on dailytorch.com. Is the U.S. about to enter a double dip recession on President Biden's watch? And that's when I noticed that the 10-year, 2-year spread was collapsing. And I do discuss the electoral implications of that. And I think, in terms of presidential politics, he's much better off having a recession right now, as Reagan did in his second year, than in his third or fourth year. as took out Gerald Ford and Jimmy Carter, who in their third and fourth years respectively had recessions and went on to be one-term presidents. Herbert Walker Bush, third year in, he's got a recession, one-term president. Reagan had it in his second year. He went on to win re-election easily. So if I'm Biden, I want this to happen now rather than later. But the midterm elections, those Democrats in Congress, they can't be loving the idea of a recession right now, because in midterm elections dating back to 1906, the party that controls the White House typically loses on average 30 seats in the House, about 3 seats in the Senate, with the just a 5-seat majority in the House, a no-seat majority in the Senate, 50-50 tied. Republicans are very heavily favored to take back both houses of Congress this year. And if there was any economic weakness, as there is, that this would only exacerbate the probably the red wave that's already building, and you see it in New Jersey and Virginia, where Republicans retook the governor's mansion in the latter case, nearly took it in New Jersey. And I think you're going to see it popping up in other states this year, Rick. How does the economy, how does consumer sentiment, how does that factor into voter kind of attitude solidifying? How quickly does Biden need some sort of recovery here, or just not going weak with like a sudden recession or something?
I would argue
the whole year. Does that help him in November?
Biden's problem is primaries in 2024, and the building of those primaries in mid 2023. So his political problem is a year and a half off. And so if you get your recession now, you get continue to high inflation, you end up with a recession now, that should ring its way out by third quarter 2023, which would be ideal for Biden, because as Paul Begala said during the Clinton administration, or pre-Clinton administration, it's the economy's stupid. And if people are saying, gee whiz, things are getting better, they feel better about things, and the right track, wrong track surveys kind of flip. At that point, that's good for an incumbent. What's bad for an incumbent is if they have the blame for all this bad stuff that's happening and there's no hope. And with Clinton, with Carter, between his failed foreign policy, the Iranian hostage crisis, the failed rescue mission in the desert, the administration is clearly in disarray, and an economy, and him telling us the way to solve the energy crisis is to make it so you're hot in the summer and cold in the winter in your own homes by not heating or cooling your homes, and wear a sweater. That's kind of that was his approach to the energy crisis. So all that led up to people saying he's not fit for the job, he can't do the job, he needs to be replaced. Biden is in that mode right now. I don't see Biden being able to recover because of Afghanistan, but from an economic standpoint, if he has one thing going for him, is if the economy is really bad in 2022 and recovers in 2023, the people won't be as mad at him as they would be otherwise. So but truthfully, I think he's a dead duck politically either way.
I think presidents are really hard to oust, and it probably would take a recession, as it has in modern history. Trump had a recession, Bush had a recession, Carter had a recession, Ford had a recession. Your last 4 one-term presidents all suffered from recession. So if Biden were going to be ousted, or the Democrats in 2024, I would bet on a recession. Deplorable Stoic, again, did they give details in which sectors the jobs were created? Did they give manufacturing statistics? Rick, you want to run the numbers?
Sure. And I've got them here, but I'm just going to do them off the top of my head. There are only about 5,000 jobs created in goods production. That's mining, manufacturing, anything that comes out of the ground that's non-farm, anything that actually makes something. The numbers there were dismal. They were terrible. Now, the last 2 months, they haven't been bad. You had growth in those sectors, about 150,000 jobs over the previous 2 months. You only had 5,000 jobs grown there. The sectors that have been the most positively impacted have been leisure and hospitality. You've had the sectors that were service sector jobs.
Your restaurants have reopened.
Your restaurants, that's exactly right. You get down to it. What do you have? You have when the restaurants were reopened because New York, California, the like stopped being stupid. That was good, and they got a lot of people, a lot of new employment. Now California and New York and DC and elsewhere are shutting those restaurants down again, or at least limiting their ability to actually function.
Not yet. People really freaked out about Omicron, and I think that thank goodness.
Massive overreaction. Massive overreaction. The other place, by the way, that has a really huge growth has been retail trade. Retail trade has been surprisingly very strong. That's the challenge is that's not brick and mortar. It's largely Amazon. It's largely the delivery stuff, and so it's a little bit tricky to see it in terms of the kind of job that's being created. But it's not but retail trade is up significantly. Transportation and warehousing up significantly. Once again, transportation, warehousing, that's the retail trade. That's Amazon when you look at that. So you look at some of those and you say, where are we actually seeing job creation? Job creation on the service sector is, if you remember back to the Bush administration, George W. Bush administration, he was always attacked because he's creating the only jobs being created are burger flipper jobs. Okay, well, when you're not producing jobs in the manufacturing, the construction, the mining and logging sectors, and making motor vehicles and motor vehicle parts, when you're not doing those kinds of things, where you're actually making stuff, everything else is dependent. Every other job is dependent upon those jobs. And when you're not creating those jobs, your economy is not growing in a strong way that's sustainable. And so when you look at these jobs that are being created, they're almost all private service providing jobs. The one bit of good news on that side is the government jobs went down dramatically over, during the 2020, particularly on the state and local area. And that number hasn't really rebounded very strongly. And we saw a report just last week that public sector union membership has gone down significantly over the last year. And that's because a lot of those state and local jobs in the public sector were laid off due to lack of revenues, and they have not been replaced. So that's good news from a limited government perspective. So we're seeing the job growth in the private sector, not the public sector. That's the good news. The bad news is the private sector jobs are largely almost all service sector and very few in terms of manufacturing and things that actually make stuff and make you stronger as a country.
Well, it could also mean, though, that the next, if there is a recession sooner rather than later, that it could, because, state and locals might be hit hard again. We have Deplorable Stoic here. He says that Biden is a mirror image, I guess he's saying, of the other one-term presidents. And then he says, are there any new releases on GDP? We did just get the 5.7% reading for 2021. But the thing you want to look forward to now is the Atlanta Fed has the latest.
The Atlanta Federal Reserve, Federal Reserve Bank
does an estimate called GDP Now. And it's only coming in at 0.1% for the first quarter. So they're definitely projecting an economic slowdown almost right away, coming off of the really strong growth in both the fourth quarter and 2021 in general. But I would just note that a lot of that is funny money. A lot of that is just priming the pump and boosting aggregate demand. And we've never spent so much money on a stimulus as we did on COVID. Bar none. And that was wartime spending levels. That was what Trump said. We're going to go wartime on this. He said, give me everything you got. He threw everything in the kitchen sink at the problem. And if that meant we get a very compressed V-shaped recovery, that's very good. But the consequence of that might mean a compressed business cycle on the outer end of that. Hopefully that means if we do come to another downturn, it's a soft and shallow one. We'd hate to go back to where we were in April or March of 2020. So I just want to make a point here, guys, that this isn't partisan. This isn't about, I did discuss the political implications of recessions, and I noticed that they harm presidents regardless of the political party. And so we're looking at what's happening right now and how does it relate to the future? Why is it relevant? And what could it mean for the future, your future? Could it create opportunities? Just because something bad's happening, it doesn't mean you're celebrating, but you could find opportunities to, foster a better recovery. Just because we had COVID didn't mean that we weren't going to try some new policies like what the Trump administration came up with, the emergency responses, particularly on the economic side, particularly protecting small businesses. I thought were very innovative at the time and really absolutely necessary. You're forcing those small businesses to shut down. You're shutting down their restaurants. And either we were going to tell them you're never coming back, and yet you're just closed forever. It would have caused a Great Depression if they hadn't done what they'd done. So you can say, oh, the debt is terrible and we're paying for it now. That's true. But we surely would have paid for it if they had just done nothing and let the economy collapse while all the state was saying shut everything down.
Yeah, here's one of the things, though. The biggest problem once you start spending is knowing when to stop. And the truth of the matter is the stimulus that passed in the lame duck session at the end of the Trump administration was a bad idea. Okay, it wasn't needed. We'd accomplished what needed to be accomplished with that at that point, and that helped stoke more inflation. And the money spent under Biden, because Biden had to have his stimulus too, was completely unnecessary.
It was
and
gratuitous.
all of that, and all of those. And so you might as well. So all the smart things that were done to limit the impact of the downturn, of the recession, the artificial Chinese created downturn because of our response to the China virus, all of that then is being somewhat negated by the fact that we kept spending. Because in Washington, D.C., the only place, and I hate to say this because I'd like to think there was a limited government party. There are limited government individuals, but by and large, in Congress, spending more money is something that's pretty popular. And so if you came up with something that basically greased enough of the interest groups, like we're going to increase the size of defense spending and then so you get the guns and butter coalition going together, and the people who just want to cut the budget, we get cut out because there's a majority who want to increase money for defense, and they'll spend as much money on the butter side as they need to get their increased defense spending. So the reality is that spending that was done, particularly under Biden, but also in the lame duck session under Trump, has had an inflationary impact. And all you need to do is look at the consumer price index numbers from 2021 or from 2020 and going into 2021, and you will see that we started having that we're 0.1, 0.2 throughout 2020. Mm-hmm. And then in December, we started creeping up a little bit. And now we're in February. In February of 2021, I think we're about 0.4, right, Robert? And so we started seeing that kind of 0.4, 0.5. And so throughout 2021, it was creeping up. And it just so now we're kind of averaging around 0.6 a month in terms of increase.
Right.
And that's if that stabilizes at 0.6 a month, what that means is we are going to be stuck at about a 7.2% inflation rate. So that's where so we're seeing it kind of flatten at 7%. Mm-hmm. But if these guys end up doing another spending bill, if they say, oh, well, inflation, we want to bring back some spending off of Build Back Better, and they go back and they do that nonsense, Katie barred the door, because the last thing we need is more demand stimulation right now. What we need is for them to stop spending, let the consumer cycle, let the whole business cycle kind of normalize. And in letting the business cycle normalize, you will find that you'll have GDP will slow. We might even go into recession, but if they don't mess around with it, it will be shallow and it won't be very harmful. But if they start playing games trying to manipulate the economy through fiscal policy, they will, because the left doesn't know anything but spend money, and they will exacerbate a problem. And because they don't recognize that it's the money supply right now that is contributing to this problem and is in fact what's going to drive us into a negative cycle because inflation tends to, except for in the 70s when we had stagflation, but tends to get the economy going too fast, and then suddenly nobody has any money, can't afford anything, and you end up on the bad side. The other thing on inflation that we can't miss, when you tell the energy sector that you're at war with them, and then the president of the United States has to go begging around the world to have them increase exports of oil. And because of Middle East policy, the Saudis say, you're no longer our ally. You've chosen Iran as your ally, who's to the death enemy with Saudi Arabia right now. You say, you're not our ally. We're not doing you a favor. And when you say to Saudi Arabia, we're not going to provide you with military supplies to defend yourself against Iranian-backed insurgents around that are on around Saudi Arabia and countries around Saudi Arabia, were firing missiles at the Saudi Arabian oil fields. And you say, Saudi Arabia, why don't you pump more oil? Saudi Arabia is going to look at you and tell you to pound sand. They're going to do a military deal, as they are with the Chinese. And as a result, we get dealt out of the entire equation in the Middle East, which means we're not able to get them to pump more oil. And because Joe Biden is dead set against American-produced energy, he's not looking at trying to turn the oil spigots on here, turn the natural gas spigots on here. Instead, he's looking at people around the world to do that and try to lower the cost per barrel from people around the world doing it. And quite honestly, he has put us in a position where we don't have leverage. And because he's out to get, and because the Green New Deal wants to get rid of fossil fuels, guess what? We're seeing we've got the highest gas prices in 7 years right now. We have on average nationwide. We also, just yesterday, it was reported that the amount of diesel fuel we're importing from Russia has gone up 300% in the last year. And so we're not producing our own diesel fuel. We're not producing we are at the mercy of people who don't like us very much. And that's the net result of a policy decision that Joe Biden's administration has made. And hence investors are saying, I'm not going to invest in oil production, in natural gas production, in those kind of things, because it's dangerous. I don't want to lose my investment because of regulatory actions. And what happens when that occurs? Guess what? You end up being dependent upon other people around the world. Gas prices go up, and energy prices going up is one of the single most influential things in our economy as a whole, because it affects every aspect of our economy, from how much is in your pocket to how much it costs to run a machine, to how much, with natural gas in particular, how much it costs to produce electricity. And as a result, it really destroys, it permeates throughout your entire economy. And that's what Joe Biden's done with his war on energy. And that's the one part of this that isn't based on monetary, it's based on regulatory policy. And it's a massive mistake. And quite honestly, he can't recover from it. He'd have to do a complete reversal, and he's unwilling to do that.
And just in terms of the inflation on the horizon, what we're going to see, the only thing worse than inflation, I think you might agree, Rick, is probably deflation. And that's just because of the sheer magnitude of the job losses that were experienced when you actually did experience deflation. And so there's an inverse relationship between inflation and the business cycle. And there's also an inverse relationship between the value of the dollar. If it starts, strengthening dramatically, that you're going to see a huge spike in unemployment, as you did during the Great Depression. This had to do with the end of the interwar gold standard. Other countries were coming off of the gold standard, like the United Kingdom. Back then it was Great Britain, I guess we called it. But in any event, they were coming off of the gold standard. They were a top trading partner. We didn't for a couple of years, and our unemployment went to the moon. And so FDR started to let the dollar weaken, and vis-a-vis by weakening the dollar. So what did we do in 2020? It was actually kind of similar, because you saw in most recessions, you'll see a big spike in the value of the dollar because there's a flight to safety. People are buying into treasuries, people piling into treasuries. That's increasing demand for treasuries. Interest rates are coming down. So the dollar's getting stronger. Interest rates are coming down. Keep that in mind. That's important because right now, the dollar coming off of the COVID weakening, there was a huge weakening. There's all your inflation. Why it inflated was because the dollar weakened dramatically. People were selling dollars. And it's like, oh, the dollar is weakening now because it had peaked. And so then you start, it's a cycle, right? And so now we're coming off of those lows and the dollar's on a strengthening curve right now. So what does that usually mean? What has it meant in the past? It always means slower growth. It always means you're going to get fewer jobs on the horizon. It's a forward-looking indicator. So it's something important. The unemployment rate is in the rear view. Inflation is in the rear view. We use rolling 12-month averages to tell you what the inflation rate is compared to a year ago. And then unemployment, that's 2 weeks old data. So you might not be catching a glimpse at what's happening right now in the economy. And for that, I would highly recommend just kind of look at those 10-year, 2 years, familiarize yourself with that, because it's not merely about predicting political cycles. It's about, you want to protect your finances, and your family. You need to know where you are in the business cycle. It's just kind of, I think any investment advisor would, they're going to, when you're in a bearish cycle, they're going to say, oh, you're going to want more bonds or something, or maybe you want, and then if it's a bullish cycle, oh, you can take a little bit more risk. And so just know where you are in that cycle, because it's going to be very, very important. But here's the thing to keep in mind. What if on CPI, Rick, we start seeing negative numbers as we did in 2020? How will that change the equation for Build Back Better in Congress?
Well, Joe Manchin's entire argument against Build Back Better is the inflation's too high, and right. And he doesn't want to stimulate the economy. If the inflation rate begins to go down, and Manchin becomes convinced that the inflation problem is solved, and Robert and I disagree on if that's going to occur. So reasonable people can disagree on what the future outcome is, because if we all knew what the future outcome was, we wouldn't be working here. We'd all be wealthy and living somewhere because we'd have bet on it, and we'd be billionaires, as opposed to sitting here talking about politics and fighting these political battles we do. But so just understand, pick your experts, take your chances. But there is a Manchin, if he feels inflation is no longer a threat, Manchin doesn't philosophically oppose what's in Build Back Better. So he is making a decision based on what he believes is the economic interests of his constituents and the timing of Build Back Better being wrong, rather than the what's in Build Back Better being wrong. And so, just beware, and remember that, because a lot of people sit there and say, oh, Manchin's on our side, he's against Build Back Better. And while he is, in politics, there's lots of reasons why people are on your side. And in this instance, he's on our side because it costs too darn much right now. And I would argue, and I always argue, that anytime we have a big government fight, we need to tell people why the big government fight matters, why the individual programs are a mistake, rather than spending our time saying it costs too much. Because the minute people determine it doesn't cost too much, we haven't made the philosophical argument why it's a bad idea.
It has to be about incentives.
And it has to be, and so if we make a philosophical argument why it's a bad idea, then people have something to say, as opposed to it's too expensive. Because ultimately, in Washington, D.C., where they print money, nothing's too expensive.
Oh yeah, and in the heart, think of back to 2020 and how little we knew about the pandemic at that point. And I think that there was more willingness, to take a gamble on spending more money, partly for that reason. And again, I was looking at that death rate, based on projections, because we didn't have much testing back then. Don't have much testing right now either. So you kind of have to go off of projections, because Biden didn't order enough tests, because he apparently didn't predict that the Omicron variant would be there, and that it would be 4 times, or even, I think actually much more than 4 times, orders of magnitude greater than the last year. There was 5, 6, 7, 8, 9, 10 times more cases this year. And if that had happened in 2020, people would be comparing what happened with COVID would be comparing it to the Spanish flu. So, just kind of thank God that when it became a very dominant strain, by then it had been far less deadly. And I think that's what people were afraid might happen in 2020, that you'd have something really contagious and then people would be dying at a much quicker rate here. We got a couple more chats here, Rick, and I think we need to wrap it up because we're almost coming up on an hour here.
We're getting almost to an hour. One of the things
let me get through these chats real quick, Rick.
Okay, go for it.
Deplorable stoic. The only way Biden's endless idiotic BS would make any sense is to start with the assumption that he's intentionally trying to destroy the country. I'm just going to disagree with that. American presidents, I don't care which party they are, they don't want to destroy America. They disagree about how America should prosper, and there's a philosophical disagreement. We have a two-party system in this country, and we're not going to get anywhere if each side thinks that the other side is destroying the country on purpose, and they're not merely having some philosophical debate. That's how you get things like
Robert,
Russiagate. That's why you get a lot of conspiracy.
I'm going to disagree. I'm going to disagree with you, and you can, because if he's not intentionally attempting to destroy the country, then you have to say every single decision he makes is wrong from a rational perspective. And it isn't a philosophical decision to pull out of Afghanistan in a way that destroys our credibility and leaves our people behind. That was a basic decision that anybody should be able to make. And in his run for president in 2015, 2016, he made that exact case that exactly what would happen if you did a withdrawal the way he did it. So he knew the consequences, and yet it had disastrous impact for this country. You wouldn't be pursuing the Iranian policy you have if you were actually trying to benefit this country. And so when you have a globalist,
but he's trying to destroy the country. You don't think that's a little over the top?
Let me finish. When you have somebody who is a globalist, by design, they are looking at the global good rather than America good. Somebody who won't say that he wants to make America great is somebody who won't ever use the word great in America in the same sentence. Is not somebody who's going to necessarily want to have America be great under the way that it has been great traditionally. You don't have friends of the free market system in the capitalist system in the Biden administration. And as a result, the decisions they make have a negative impact on what happens in this country. Whether Biden is intentionally saying, I'm going to destroy America or not, is neither here nor there. His choices have that effect. And so at that juncture, you can be right. Maybe you don't need to attribute the absolute negative malicious intent on Biden, but the net effect is, if this guy went to Vegas and bet on dice and said, and he had a 50-50 chance to lose, I mean, he's the reverse Hillary Clinton on cattle futures, man. This guy loses every time there's a bet he makes. And America suffers. And it's been true for 40 years in terms of foreign policy, according to former defense secretary of the Obama administration. And we're seeing on economic policy he's no better. So, yeah, the decisions they're making are catastrophic. They don't make sense. They're doing exactly the opposite of what you would do if you were trying to build the country. And as a result, it's fair to question motives. I will tell you this, that it is important, as we're dealing with the election cycle, is important that we not be questioning the motives of those who are in opposition. Because if the objective is to bring people over to our side through a common sense approach and reaction to the negative consequences of bad policy, we are better off to rather attacking motives to attack the policy. Because the objective is to get people to reject the policies that are causing the problem, because when they do, we end up with people embracing limited government, personal freedom policies, rather than top-down, big government, one-size-fits-all policies. So from a practical perspective, no matter what the motivation, the objective is to win on the policies, because that has 10-year impact, rather than, I don't like this guy and I don't trust his motives, which is very focused on one individual and has no long-term impact in terms of our ability to turn this country around.
Well, and I think that the reason they're going to move the legislation as quickly as they did, again, I don't think there's any animus against the American people or the country as a whole. I think it's because they know they have about a 2-year window to pass big legislation, and that there's a red wave coming, and the president's party doesn't do well in midterms, so they're going to try to pass as much legislation as possible that are policies that they agree with and that we probably disagree with.
Well,
There's no much, you don't need to know much more else about it. It's that they know they're losing power. They're going to try to ram through as much stuff as possible because their constituents are demanding it. The interest groups that elect, that support them are demanding it. The people who voted for them. They like those policies.
Also,
sorry,
Robert, I think there's another piece to it. They learned with Obamacare that they were going to lose by doing one big thing, and they're going to get creamed. So why not do 10 big things? And because if you're going to lose anyway, you might as well lose doing 10 big things.
Isn't that what we said in 2018?
And the second lesson they learned was that if they get them in, the Republicans can rail against them all they want. They're never getting them out, because there's never been an issue that had more consistent negativity in terms of electing people to get rid of it than Obamacare. And yet the Republicans, even using budget reconciliation, were unable to come up with 50 votes against Obamacare and against the parts of Obamacare that they could deal with in budget reconciliation. They were not able to come up with 50 votes. So guess what, folks? The Democrats learned a lesson. We passed it. The Republicans will never have the guts to get rid of it. So that's the reality. And until the Republicans prove otherwise, until the American people make the Republicans actually do something, as opposed to just talking about it, until that occurs, guess what? The Democrats are right. So they're going to press their agenda as hard as possible, and it's going to be unrelenting, because they know that once they get the camel's nose under the tent and get something in place, the administrative state will build it out to a massive bureaucracy that takes away our power, the people's power, and that will happen. It may take 10 years, but that's how they end freedom and constitutional liberty in America. It's they always try to score touchdowns, and the Republicans are playing for a 57-yard field goal all the time. And that's just the difference.
A couple more chats here. Deplorable Stoic. First president to intentionally disregard his constitutional responsibility to protect the borders. To me, that says it all. Besides Trump, I'd say that actually characterizes the past several presidents, but so we can disagree about that. Deplorable Stoic. Watch Biden, his career, and he has never had America's best interests at heart. All right, and I just disagree. I don't think that's the mindset of people who are in government in general, the elected officials. I think that they think they're doing the right thing. I think they want to be lauded by history. I think they have an incentive to do things that actually turn out good for America. I think people want to be remembered as a good president. That's a pretty good incentive when you're the leader of the most powerful country in the world. And he's in it for himself and the almighty dollar. And on that dollar, I'll just say, guys, just pay attention to the general strength of the dollar. It tells you a lot. It runs opposite to things like exports, inflation. Inflation when the dollar's weakening, inflation's going up. When the dollar's weakening, exports are going up. A lot of things are behaving like you see a lot of GDP growth coming out of that. But if you run it too hot, if you weaken too fast, if you have too much inflation, it's bad. If you have too much deflation, if the dollar's getting too strong, it's bad. I prefer a world of price stability. I agree that we need to get the economy into a normal business cycle, Rick. And hopefully coming out of COVID with Congress really tapping on the brakes, Build Back Better doesn't look like it's really going anywhere. I think Joe Manchin is really, hammering the final nail in the coffin there. Perhaps economic circumstances could dictate a turnaround on his side. But I honestly think there's a lot of acrimony between him and Democratic leadership, particularly on the House side and the White House, that are very frustrated with Manchin for not going along with their plan to just throw helicopter money from the sky. I mean, you probably, if they had passed that back in early 2021 or mid 2021 or late, even towards the end of 2021, I think you'd be seeing inflation jump up much, much higher and maybe even double digit instead of looking like hopefully we're peaking already. And so maybe we can get back to normal, Rick, and I'll let you get the last word.
Yeah, well, folks, this is a couple of things. What we've kind of opened up a window for you guys. One of the great things about working and leading this organization is, I've got really smart people who work here, and we spend a considerable amount of time. We don't call ourselves a think tank because we're action oriented, but we spend a considerable amount of time fighting back and forth on different issues, taking a look at data and saying and arguing what it means. And it doesn't mean you come up with the same conclusion, but we have a depth of argument about what different things mean, what the impacts are. And then we come to a conclusion in terms of, okay, how do we want to approach it? And in some instances, we say, okay, well, you believe this, and it's not a knowable thing, so you can talk this way, and I'll talk another way. But it's all from the same foundational data and how we interpret it. And the interpretation is always oriented towards limited government. So, but it's really the window we've tried to open today has been kind of that discussion a little bit about how we look at it. And believe it or not, Robert and I sometimes spend 2 to 3 hours during a day arguing about what's happening on different subjects, so we can come to a conclusion about what the right approach is. And it's that part of intellectual rigor, the part of really trying to figure it out, not just by going knee-jerk talking points, is one of the things that Americans for Limited Government does that most people don't, quite honestly. We were going to talk a little bit about why the Bureau of Labor Statistics unemployment numbers on the household survey are really just not usable this month. I'll just say that they've changed every year they change the sample of how they do their survey, and so you're comparing apples to oranges between December and January, and that's why we didn't talk about the household survey at all, the unemployment rate, the jump in job and the employment numbers and all that, because it's completely untethered from last month's number, and so you can't really compare it. And
it's a population adjustment. And so every year, as Rick was saying, the Bureau of Labor Statistics will adjust the entire data set for growth in the population based on, basically, what is it, monthly, weekly, however often they're gathering census data. They gather over the entire year. And then at the end of every year, they reset the BLS data set. So January is always kind of boring to talk about. I guess this was the exception in the past 10 or 12 years we've been looking at these reports. The January, we almost have nothing to say about the January report. So
right.
I think we managed to get an hour and 6 minutes here. And so I just want to thank everyone for tuning in. Thank you, Rick, for taking an hour out of to explain what's going on with the economy and these jobs numbers. It's a lot of detail, a lot of moving parts, and a lot of different factors to consider about where the jobs market is. Is the recovery now in the rearview mirror? Is there stormy waters ahead? I think there might be kind of buckle up situation there. And so, how do you find us? On YouTube, Americans for Limited Government, Rumble, Facebook. Check out dailytorch.com. If you're watching right now, hit the subscribe button, ring the bell for notifications, and have a great weekend. Take care, guys.
Thank you, folks. Take care.